Welcome back. Markets are down, as you can see, in the early minutes of trading. We've been open now for about 8 minutes on Bay and Wall Street. And you can see the direction of travel is down thus far for equity markets. Let's bring in an expert to talk about markets. David Aspell is Co-Chief Investment Officer at Mount Lucas Management. David, thanks a lot for joining us. Why don't we begin with earnings season? We are seeing some relatively strong earnings out of some big players out of the U.S. today.
Yeah, it looks like it's off. We're up to the races. I mean, the next couple of weeks, I think we'll see an enormous amount of earnings, but so far it looks like they're okay. I mean, stocks they're down a little today, but we're at all-time highs, and we're seeing stocks that are doing well and beating earnings. It seems like the market reaction is pretty strong.
What are your expectations for S&P 500 earnings season by the time it is over? What kind of earnings growth do you think we will see?
Yeah, I would say, I think at the index level, we're looking at around about 240 for the year, which will be a record. And next year, it will be fascinating to see, particularly if there's a change in administration, see how the economy goes through. But next year's earnings are currently estimated at about 270. So it's strong earnings growth. But again, we're in a world of fairly strong nominal GDP growth, and we've got fairly strong, fairly large deficits out there, which I think will be supporting things also. But as far as we can see, it looks like the economy is pretty robust, and that generally relates to and translates to pretty good earnings growth.
And multiples, are the current multiples stretched or justified by the strong earnings performance that you've just cited and the relatively strong or at least benign macro environment that you've just cited?
Yeah, I would say so. They're fairly high. I don't think anyone out there would say they're cheap, but a lot of the measures that you see, like the CAPE ratio, the cyclically adjusted PE, it misses that, currently the companies that make up the index are in a particularly good shape, relative to 10 or 20 or 30 years ago. So when you're doing these long-term comparisons of PEs, sometimes you miss that the companies that are large in the index are growing a lot. They have pristine balance sheets and very high cash levels generally. They're just better companies than you had maybe 10 or 20 years ago. So I think although they are fairly high, it's somewhat justified by the fact that the companies themselves are better and in great shape.
Everybody's talking about gold these days, which continues to push higher. The gold stocks that trade here in Toronto have posted huge gains. I know you've written about gold in some recent commentary as well. What's your take on this gold market?
Yeah, gold. It's an odd commodity. We run systematic trend following strategies, and they've been long for the last couple of years, and picked up the move as it's hitting all-time highs. It seems almost every day. It's an odd commodity. I think that most commodities generally have their own supply and demand curve that's driven by the actual uses of the thing, whereas gold doesn't really act like that. To some folk, it's a currency. To some, it's an inflation hedge. Others use it as a store of value. I think generally that what's going on is that there's a lot of countries that are maybe on the bubble of being friendly with the US that are trying to keep assets out of the reach of the US government, and there's not that many places where you can put large amounts of money. Generally US treasuries are the place, but if you don't want to do that, then maybe there's European bond markets act as a somewhat safe place, but with the issues in Europe and the lack of growth there, maybe that's less attractive. And I think for a lot of countries, having some physical gold that's out of the reach of the US government and has always been a store of value is a somewhat of a more attractive option than it used to be, that weaponization of the financial system and the dollar. And I think that doesn't seem like it's going to be going away. I think that's one of the things that is supporting the gold price, certainly.
What about U.S. politics? The election looks like a coin flip. There's great uncertainty, which can benefit the gold market in terms of who wins the White House, certainly in November. And there does seem to be a sense of confidence that whoever wins will drive deficits higher in the United States, and that can be gold positive as well. Yeah,
certainly. The election seems, it's only a couple of weeks away now, right? It's getting here quick. There's a lot of uncertainty about the election, clearly. Implied volatility in the equity market and the bond market are very high. And I think some of that is clearly feeding over into gold. I mean, to some folk, that I think it's pretty clear that the Republican Party of 10 years ago that was very concerned about the deficit is gone away, and both parties seem like they're looking to be spending more money, and the money printing deficit fears certainly are driving some people to that to goals. And I can understand the logic, because it seems like both parties are prepared to spend.
Why don't we finish with China? There have been, of course, recent moves by the Chinese economy to stimulate the economy, the property market, and the stock market. How likely is it that in 2025, concern over a sluggish Chinese economy will be less of a headwind for stock markets around the world?
Yeah, I mean, that's a huge question. I think it's one of the largest things that's going on right now. We've seen a very large, very fast rally in the Chinese equity markets as the government has changed course. It looks like, clearly the economy has been slowing down there. And, I think of it much like the COVID restrictions that they had. They were very strict with COVID restrictions right up until they weren't, and they just removed them and changed course. And obviously it's a large economy, but it looks like they've hit that point where they are changing course, and they're not accepting the current level of growth. And if you think what's going on, it's 130 trillion yuan economy. It's about $18-20 trillion. And they've got a 3 or 5% hole in that economy from as the private sector, if they want to hit their growth targets, because the private sector is kind of flattish. And it seems like they are just going to fill that with a litany of different stimulus packages. Some are coming from the fiscal side, they're taking a little bit longer, but the numbers that you're seeing are very large. And when you add that in with the mortgage rate cuts, the reserve requirement cuts, they're doing very meaningful things here that, I think they're very large. And I know the market is struggling to digest them currently. There's a lot of volatility, but it seems like we're at the whatever it takes moment. And they are doing that. I think it would be foolish to bet that they will not be successful.